Okay, everyone, welcome to our brown bag today. I'm going to give a few minutes to allow for some additional participants to log in. So about 3 more minutes, we're going to start at 12:05. I have the majority of everyone muted, but if you have a question, our presenter, Stephen, said that it's fine. You can either put your question in the chat or you can ask if you can take a second to ask a question along the presentation, that's fine. But if you can remain muted for the majority of the program as much as possible so we don't hear a lot of background noise, because we are recording this for GPS. And Stephen also mentioned that if you do want to share your cameras and you have that capability, you can do that as well. So we'll give a few more minutes and we'll start at 12:05. Okay, hello again, and welcome everyone to today's brown bag. Today's presentation is Plant Your Tax Savings Garden Early. Giving our presentation today is Stephen Newman. Stephen is the managing shareholder and president of Newman & Company CPAs. He joined the firm in 1983 as an accounting manager and became a shareholder in 1985. A native Clevelander, Steve received his Bachelor's of Business and Administration in Accounting, magna cum laude from Kent State University in 1979. In addition to being a CPA, Steve received his certification as a certified valuation analyst in 1998. As a CVA, Mr. Newman values businesses for sales acquisitions, estate and gift tax planning, divorce, and other litigation matters. Steve is a member of the American Institute of CPAs, AICPA, the Ohio Society of CPAs, OSCPA, the Tax Club of Cleveland, and the National Association of Certified Valuation Analysts, NACVA. He hosted the radio show Financial Opportunities, which aired on WCLV 104.9 FM on Sunday mornings from 2006 through 2012. Steve served on the South Euclid Lyndhurst Finance Advisory Committee and was the treasurer for the school system levy campaign. In addition, he enjoys volunteering for Habitat for Humanity. Welcome, Stephen.
Thank you. Thanks for having me. And it looks like we got a decent sized group. Yeah, this is good. This is great. I hope I can help, and I welcome questions. And if the questions come after today, that's okay too. Angela, will people have the PowerPoint so they can refer back to it?
Yes, I will send an email to everyone who is part of the presentation today with the presentation on it, as well as information on how to receive their Healthy UH points.
Okay. And then, in the PowerPoint presentation, it has my contact information. I like getting questions, so feel free today or later. So, as Angela mentioned, the name of the presentation is Plant Your Tax Savings Garden Early. I like analogies. So when you're planning for anything, takes time, takes a little bit of effort to prepare fertile ground to be successful. I analogize it to a garden. You could analogize it to a grove of fruit trees, right? It would take time to bear fruit. So some things are immediate, and I want to go to the next slide. So Angela.
Hold on 1 second. I'm gonna stop for a second, just
Yeah.
because someone said they couldn't see the presentation, so I'm gonna share it one more time.
Okay.
Can we see it?
Yes.
Yeah. Okay, good. All right.
Okay. Okay. So I want to talk about what's
Oh, it's, for some reason, it's not.
it's moving. Yeah.
Here we go.
That one's the one I want. Okay. What's recently changed? I want to talk about things that have changed. I'm going to start with the Tax Cuts and Jobs Act of 2017, which for the most part became effective January 1st, 2018. But you know, when you're in the path and you have some momentum of how you understand things and how you file tax returns, something that became effective as a change in 2018 could still seem pretty fresh. So here's the thing. If the first item, no need to itemize deductions for most taxpayers. What happened? Well, that Tax Cuts and Jobs Act doubled the exemption, the standard deduction. So immediately went from 12,000 to 24,000 and indexed with inflation and additional amounts if you're age 65 or older. So a lot of people stopped bothering with adding up their mortgage interest expense and their real estate taxes and their charitable and their medical, those kinds of things, and just opted for the standard deduction. There is a way to periodically itemize depending on your circumstances, and we're going to get to that in a later slide. By the way, things like miscellaneous itemized deductions, paying for tax-related advice from a CPA or an attorney, or money management fees for managing a portfolio, those things are not deductible anymore at all, including things like employment-related business expenses. Those things are not deductible at all anymore. But there is a strategy for itemizing. If you thought that is a thing of the past for you, depending on your circumstances. The next item, IRAs for all ages. Well, they capped IRAs that even if you had earned income at age 70, you had to stop contributing to an IRA. Well, now that's not true anymore. Anybody who continues to have earned income, and what I mean by that is any income that's subject to Social Security and Medicare tax. That would be a job, that would be a side gig, or a main occupation. Maybe you have a spouse or a friend that has their own business. They can continue to contribute to an IRA based on either self-employment income or an IRA, or a W-2 without any age limitation. Okay, mortgage interest limitations are more stringent. What that means is that there is a overall limitation of something called original home acquisition indebtedness. A mouthful, but what it basically means is to buy, build, or improve your home. The new cap is $750,000. You still can use a home equity line in order to accomplish that. But it used to be that you could use a home equity line for any purpose, like go on vacation or refinance credit card debt. And that no longer is the case. For you or a loved one that is thinking that before too long they have to take out required minimum distributions from their retirement accounts, well, that changed. Used to be age 70 and a half, that got moved up to age 72. If you were already in the minimum distribution routine, if you'd started it, then regardless of whether you're age 72, you have to continue. Here's something under what's called the Secure Act. If you inherit an IRA, and you're not the spouse, but if you inherit an IRA from your parents, your grandparents, a relative, a friend, you have to take the money out over 10 years. If you inherit a traditional IRA, you'd probably want to take it out evenly over 10 years. If you inherit a Roth IRA, assuming you're over age 18, still the 10 years applies, but you'd want to wait until the very end of the 10 years because it's going to be tax-free when you take it out. So you might as well give it the chance to grow over time. Tax rates are lower now, but they're going to be higher on the horizon. I do want this to be interactive if people want to participate. Does anybody know why my prediction that tax rates are going to be higher in the future are pretty sure bet? If you do, you can say in the chat, and I'll go back to that. COVID-related tax breaks. Well, if you have a business, meals are 100% deductible instead of 50% or sometimes 0% for the years 2021 and 22. That's a, yeah, well, Kava Naimi says the reason we need to plan for higher taxes because we need to pay back the COVID relief. Yeah, that's true. Okay, David Leach says that in 2026, we're going to return to the old rates. That's true too. A lot of things can happen between now and 2026. But I drive to, stimulus payments. Aubrey Norton said it's because of stimulus payouts. All those are true. I drive to work from the east side. I come in on 77 North, and this morning there's a billboard. I look at the billboard every day when I drive in. So the national debt as of today, $27,829 billion. It's about $84,000 per person. How will we ever pay that back if we spend more than we make every single year as a country? We spend about $3.5 trillion. We bring in about $2.8 trillion. We wouldn't run our household like that. So something's got to give. Back to the COVID-related tax breaks. If you have a side business or somebody that you know has a self-employment activity, there are these PPP loans, Paycheck Protection Program loans. It's a phenomenal thing. If you haven't taken advantage of it, they just reopened access to the original PPP loan program, and there's a second round also, basically 2.5/12, or 20.833% of the payroll that you had in your business or your profits, you can get as a loan from the SBA through your banker or lender. And if you spend the money the right way, which is not very hard to do, pretty easy to accomplish, the loan is forgiven. It's a phenomenal program to support people who have small businesses and people who have small businesses and have employees, so both. One other COVID-related tax break. There are charitable contributions, even if you take a standard deduction, starting in 2020, it's a permanent change. Husband and wife, $300 and $300, you can take as long as you spend it, by writing checks, and you'd want to get receipts. Up to $600 for a couple, $300 for an individual, as a deduction on your tax return, even if you don't itemize your deductions. So that's low-hanging fruit. Most people have at least some charitable contributions, so everyone should be in on that. And then for those people that may have an inclination, wherewithal and inclination to give a lot to charity, there historically are limitations about what percentage of your adjusted gross income that you can deduct, and that's now up to 100%. I want to answer Hillary's question. Says that she donates per pay to a charity, and yep, even if she doesn't itemize deductions, Hillary, looking for you on the board there, you'll be able to deduct. You'll be able to deduct it. Yeah, it sounds like from what you intimated in your chat there, that you'll get, if it's just you, $300. If you have a spouse, $600 is a tax deduction on your tax return. So thanks for asking the question. Okay, let's go to the next slide.
There's a little bit of a delay, so 1 second while the computer thinks about what I'm doing.
Thanks for telling me. Yep. Oh, okay. So Lisa asks, are there COVID deductions for working remotely at home? Not really. No, there aren't, because those deductions, they're called employment-related business expenses, used to be a deduction, no longer available since the Tax Cuts and Jobs Act of 2017. Okay, all right. My intention for this presentation, what are best practices, not only from historical tax law, but recent changes. So let's go to the next slide. Okay, here's what I was talking about, where you might be able to itemize deductions, even though normally speaking, you would take a standard deduction. So let's just say for an individual, you know what, let's do it with a joint tax return. So let's say for a joint tax return, and I don't know the exact number, maybe it's about 25,000 standard deduction, assuming you're under age 65, husband and wife. And you say, geez, why should I go to all that work to add up my medical and my taxes, real estate taxes, state and local income taxes, mortgage interest, charitable, when I know I don't spend 25,000. But let's just say maybe you are charitably inclined and you give 10,000 a year to charity. I'm making it an easy calculation for myself and for everyone to understand. And so let's say you don't have a lot of medical, so let's knock that one out. But you do have real estate taxes and state and local income taxes. Let's say that's 10 grand. And let's say your mortgage interest is 6 grand. And let's say your charitable is, let's make the mortgage interest 5 grand and the charitable 10 grand. Normally speaking, you add those three together, you get to 25 and no point, because you get a standard deduction at 25. However, if you were to use, if your normal routine is to continue to give 10,000 a year to charity, and of course you have to adjust for your own numbers, you could instead, if you had the wherewithal and the willingness, put 30,000 into a donor advised fund. And many organizations will set those up for you, anywhere from Catholic Charities to Fidelity or Schwab. They'll set up donor advised funds. You put in the 30,000, you get the 30,000 deduction all at once. Let's say you did it in 21. So in my illustration, you got 30,000, you got the 5,000 in mortgage interest, 10,000 in taxes. So now I got $45,000 in itemized deductions, 20,000 more than that 25 of standard deduction. And then what happens is you, with your donor advised fund, you inform them, you make recommendations, you open the spigot every year, and all those charities that you support, you let them have their charity in 21, 22, and 23. You only get the deduction of 30,000 in the year 21 when you funded the donor advised fund, but you're still supporting all your charities, and your charities it's invisible to them that you're front loading a donor advised fund in order to continue a steady, continuous support of their charities in years 21, 22, and 23, just because you could fund, Anita asked, could you fund a donor advised fund every year? Yeah, but you probably get more juice for the squeeze by bunching it or concentrating into 1 year. So you far exceed the standard deduction in my illustration, because if you funded the donor advised fund every year, you still only get as a charitable contribution what you contribute. The idea of the donor advised fund, the strategy, is to front load it and open the spigot for a number of years. I used an example, 3 years. Doesn't have to be 3 years. No, does not have to. Someone, Hillary says, does the donor advised fund have to be 30,000? Nope, just an illustration. You could give 20,000. You could give any amount that helps you go over the standard deduction limit so that you can get extra tax benefit. The idea would be overshoot the standard deduction in 1 year. I'm just using 21 as an example. Open the spigot in 21, 22, 23, let it out slowly, could be 4 years. Standard deduction for single, getting a resource here, the standard deduction for single, 12,400. Someone just asked, assuming you're under age 65. Yeah, okay. But it could be any amount. You just got to work out the math, okay? And then in my illustration, years 22 and 23, you take the standard deduction even though you don't have any charitable because you front loaded it in 21. So you get your standard deduction, kind of like, getting some free money in 22 and 23. And if you looked at the 3 years in the aggregate, you're ahead of the game without spending any more money than had you doled out your charity evenly in 21, 22, and 23. You're getting an extra $20,000 deduction over the 3-year period. Okay. And I know it's a lot to absorb, and it conceivably is a very new concept to our group here. So you can ask more questions. You could also reach out to me by phone or email afterwards, and I will be pleased to patiently talk to you about it. Okay, Angela, next slide. $529 plans. Hey, so I guess I could ask people to raise their hand with the reaction button, right? I want to know who uses a 529 plan. Okay. Yeah, the number's growing. Okay, so maybe right now about a fourth of the, I don't know, maybe a fourth of the group. Okay, so 529 plan. It is the best way to save for college. Could be even for yourself, but generally for your children or for grandchildren or a young person that is the child of a friend. There are no real limitations as to who you put money into a 529 plan, but the deduction is up to $4,000 per tax return per child. So let's just say you had 3 grandchildren and you wanted, or let's say 3 children, and you want to put in $4,000 for each one of them, you'll get a $12,000 Ohio income tax deduction. No deduction for federal, but you get it on Ohio. If you put in more than 4,000, then you wear that amount away by taking the excess, you carry it forward and you get to take it as a deduction on your Ohio tax returns in the future. Do it early. When the kid's got a social security number, that's the time to get that 529 plan opened up. Generally speaking, the parent's going to open up that 529 plan, but grandparents or other people can contribute to it. They can send you a link. If grandchildren don't exist yet, can you still put away money? No. The person that gets amounts for their 529 plan has to be born, has to have a social security number. Okay. But you could catch up. You can catch up. Even you could set the money aside, and then when that child is born, social security number is established, establish the 529 plan. Okay. Not sure what the question is right now. Yes, you can put in a 529 contribution for yourself and get a contribution if you're going to college and you're kind of going a steady, slow pace. At least your money can earn an investment yield. Here's what's great about 529 plans. The investment yield is never taxed as long as the funds are used for K through 12, private school, college. You can put money, Molly wants to know if you put money in a 529 plan, but the grandkids live in California, you'd have to get an Ohio plan to get the deduction, but you can certainly put it into a California plan also. Now, here's the thing. I'm just going to be contemporaneous about it. What if the grandchild has money in the 529 plan? Does that count against their financial assistance? That rule's changed a lot. It's not really a tax rule; it's a 529 plan rule, or it's a FAFSA rule. I think it may be excluded now. I think that it was to encourage people to do 529 plans and not hurt them on the FAFSA, but you'd have to, I can't guarantee that. You'd have to check it. But I want you to know that if you contribute to the Ohio's College Advantage program, it's good for any institution in North America. You go to McGill University, it could be any state. I believe you can use 529 funds to pay for college supplies, including a laptop. By the way, you could write this down. You could call the Ohio College Advantage program. It's 1-800-AFFORD-IT. I don't know what the numbers are, but I remembered that. AFFORDIT, 1-800-AFFORD-IT. They're very helpful there. You could also just go to collegeadvantage.com. There's a lot of FAQs there. So what happens if you put money into a 529 plan and it's for a child or grandchild who never goes to college? At least in Ohio, you can transfer the account, the balance, all the way to first cousins. If no one goes to college, you can get the money back, most of it. You lose 10% on the earnings. There's a penalty of 10% of the earnings. But if you put in 30,000, it grew to 50,000, you got a 10% penalty on that 20. So you'd lose 2,000, and that 20,000 would be subject to income tax. But if the child never goes to college, my thinking is you transfer the account to them if you want them to have the money. Maybe they're going to be an entrepreneur, and then let them cash it in and let them pay tax on the earnings. Okay, next slide. So this is my motto, be kind to your future retired self. Picture yourself in the future. You'd hate like heck to be retired and go to your kids for a handout. You want to be a financial anchor in your family. You also want to lead by example. So next slide. So what are the buckets to fill up? And I always say, give till it hurts. It's for you. And make sure you take advantage of the tax breaks. Make sure you take advantage of an employer match. I know you've got 403B plan at work there. At a bare minimum, give as much as you need to so you get all of the match. But I would stress yourself with your 403B plan, and put in as much as you can, because once you finally, let's just say at first it's hard, but then you get raises and it becomes easier. Just weave it into your budget. I'm sure you've heard the expression, pay yourself first, and that's that kind of idea. I also want to talk about the difference between traditional IRA and a Roth IRA. Your questions are welcome as we go. In either case, you need to have earned income, and that means a paycheck, W-2. If your spouse, let's say, doesn't have earned income, okay, I don't know what UH's 403B match is currently. Most plans are at least 50 cents on the dollar for the first 4 or 6%, but I wouldn't be surprised if UH, oh, there it is. Okay, 50% of the first 6%. Anybody, check your pay stub. If you're not putting in your 6% to get the 3%, that's a 50% return. So yeah, put in the 6%, change that right away, and you could catch up too. For the whole year, you want to at least have 6% in so you get the 3%. Yeah, so it's a cumulative thing. It's a measurement against the whole year. So if you didn't do it at first, you can catch up now, divide your remaining paychecks into that dollar amount. So you make sure you get the 6% of your gross pay in before the end of the year as a deferral, so you get the 3%. Where to get a traditional Roth IRA? There's so many places. You could go on E-Trade, you could go to Schwab or Fidelity, your bank, but you definitely, if you have belief in the market to pay off over the long haul, certainly want to be in a mutual fund or some sort of equity securities rather than a bank account, because we all know a bank account doesn't pay any interest right now. You'd be lucky to get 0.5%, most often less than that. But can people raise their hands if they understand Roth IRAs? So far, I've got 1, 2, 3, and we are like 23 people here participating, because I'm not counting me, Andrew from my office. Well, I guess I should count Angela. You're part of the group. So most people really don't understand. Oh, good. Jocelyn just says, I don't really understand a Roth IRA. I'm glad I'm going to talk about it then. So let's do a compare and contrast. So so let's just say you put $6,000 to a traditional IRA and your twin does $6,000 into a Roth IRA. And so you get a $6,000 deduction on your tax return. You reduce your income for federal and state income taxes, but your twin says, well, I don't really want the deduction now, but I never want to pay tax on the money. So your twin puts $6,000 into a Roth IRA. They don't get any tax deduction today, but let's just go out 10 years from now on this $6,000. 10 years from now, the $6,000 is worth $60,000. Now, you might say that's awfully, it's an exaggeration, but those things do happen. Market can perform very well, could go down, but over time it goes up. So, but let's say we put in 6 and your twin puts in 6. Now it's 10 years later and it's $60,000. And let's just say you want to take the money out. Well, if you go to take out the $60,000, your traditional IRA where you got the deduction on the 6. So let's say you got a $1,000 tax benefit. You go to take the $60,000 out in 10 years, you got to pay tax on $60,000. And sorry about that. Just had to mute my phone. Okay. Now your twin that put in the 6,000, now it's worth 60,000. As long as they're 59 and a half, it's okay. Take the money out. All 60,000 is tax free. So I know my example is kind of a stark comparison, but over time it makes a lot of sense. And boy, does it make sense for children. If you have kids that are earning a little bit of money, if you take away nothing from this presentation but this, if after 59 and a half, you become eligible to take, Hillary's asking me a question, become eligible to take out the Roth IRA without any penalty on the earnings. If your child has any kind of earnings, summer job, part-time, I did this with my kids, whatever they make on their job, up to $6,000, they can put $6,000 into a Roth IRA. There's no point in having a traditional IRA for them because they're not going to get much of a tax deduction, if any, because their tax bracket's almost zero. If you only get them to do it once and they're 16, 17 years old and they put $6,000 into a Roth IRA today, yes, the Roth contribution is after tax money, no deduction for that. Molly just asked. And Erica asked, is it per year? Yep, it's per year. Actually, right now you could put in for 2020 and for 2021 right now. Someone's asking, is the traditional taxed after 59 and a half? Well, it's taxed when you take it out. If you take it out before 59 and a half, you get a 10% penalty also on the withdrawal. But let's think about that child, 16 years old. They're working at an ice cream shop. They make $3,500 and you say, hey, we're going to help you. You put in some of your money. We'll put in some of your money. Let's put in $3,500 because that would be the max because it's based on the wages. And let that stay in there from age 16 to 66. Can you imagine what that $3,500 might grow to? They will marvel at the condition they're in when they're retired because they planted a seed when they were 16 years old and you encouraged them. And get a few years of Roth IRAs in when you're young and you'll really harvest a completely tax-free benefit in retirement. Think about this. Run it parallel to the insecurity that we all have about Social Security. Will it be there when we retire, or when your kids retire? So I like to run it as a parallel road to the expectation of Social Security and, of course, your 403B plan. But it's a hedge. It's a hedge against the future. Okay. Did I explain Roth IRAs well enough? Does someone have a residual question? There is a cap on the Roth IRA, not on the accumulation, but on the contribution. Someone asked about conversions from traditional to Roth. I'm a fan of that too. Of course, everything in moderation. You got to be able, as we go, I'm answering questions. Someone says, is there an income constriction for Roth IRAs? Yes, I'm going to go to that. So, but you can do conversions to Roth IRAs. There's no income constriction on conversions anymore. There used to be, but there is an income restriction or limitation on the, and I'm just looking it up right now. Yeah, so if your adjusted gross income is between 196,000 and 206,000, then you are restricted, prevented, it's a Mary filing joint tax return from contributing to a Roth IRA. And that's where you'd have to do a backdoor method. And I'll tell you what that is. The backdoor method is if you do have an income limitation, you can't put money into a Roth IRA, you do a two-step approach. I tell people just do it on January 1st. Put 6,000 or 7,000, whatever your limit is based on your age, into a traditional IRA. Probably is non-deductible because you're probably in a retirement plan too. And then the very next moment, you convert to a Roth. You can do it as an annual routine. And that's a fantastic annual routine. Let's say you and your spouse do that, 6 and 6, 7 and 7. You do it every January 1st before the ink is dried on the contribution form. You fill out the conversion form. There is no time limit. You just do them sequentially. So if you put 6,000 in January, immediately after, you could still be at the counter at Fidelity. Fill out the contribution form, fill out the conversion form, and they'll just process them in sequence. Any other questions about Roth IRAs or Roth conversions? Yeah, and somebody did ask about, can you choose your investments? There's no limit on where you invest, what investments you choose. You just got to start. Once it's in, you're in control. If you want to buy Apple stock or you want to put it into a mutual fund, doesn't matter. You can move it around, mix it up as much as you want. Yeah, so someone says, Hillary says, UH gives you limits on where you can invest. That's true. Some 403b and 401k plans give you a self-directed corridor. No, you cannot use pension dollars to go into an IRA. If you're taking money out of a pension, you cannot funnel it into an IRA. Okay. The income limit has nothing to do with your ability to convert. Used to be 100,000 adjusted gross income, and no longer any restriction on conversion. Anybody can do a conversion, just got to be willing to pay the tax on the conversion. I'm going to switch over to health savings accounts. Anybody familiar with health savings accounts? Raise your hand if you are. Okay, a few people say they know, and oh, a lot of people know. Good. So health savings accounts, high deductible, a lot of people know. Here's the best practices with health savings accounts. Fill up the savings account aspect. You're paying a premium. I mean, your employer's probably paying a premium, you pay a portion. You know, you get a tax deduction for your portion that you get to do a pre-tax for the premiums. But in addition to that, you can fill up the savings account. That's a deduction. You might do it through work, but you probably can do it outside of work also. It's around $7,100 for a family. If you're age 55 or older, by the end of the year, you can put an extra $1,000 in for you and your spouse. Store the funds. Don't use the funds if at all possible. Use your other money to pay for medical expenses. Invest the money. You can put it into mutual funds. and save it as a game plan for long-term care. That could be your long-term plan out in the future, or out-of-pocket medical. Everyone's going to have some medical eventually. Most people will. So that health savings account is one more opportunity for you to be kind to your future retired self. Can you invest HS money in a Roth IRA? No, they are dissimilar activities. But the HSA money itself has similar features to an IRA, and it also has similar features to a Roth IRA in that as long as you use the money, yeah, you can use it to pay for long-term care insurance premiums. Yeah, that's a good one. And as long as you use the money for medical related expenses, okay, someone's asking about stopping to contribute to an HSA 6 months before Medicare. Well, you have to stop contributing to an HSA the last month is the month in which you turn 65. But anyways, if you use the HSA money for medical related expenses, no tax. So it really is kind of like a Roth IRA, even better because you get a deduction on the way in and no tax on the way out. So an HSA is really kind of the very best vehicle you can find. Where do you get a deduction on the way in and no tax on the way out? You don't get that with a traditional IRA. So think about HSAs, health savings accounts, filling up the savings account, invest the money, don't use the money. And if you never have medical expenses, you can leave your HSA account to your children or your grandkids. It'll be like an IRA for them. They'll have to take the money out and get taxed on it. Okay, yeah. Someone says they're contributing to an HSA after age 65 and they're not on Medicare. Well, if they're contributing to the savings account, I'm surprised about that. But premiums would be different. You can get an HSA savings account through your employer, or you could do it on your own. I know you can do it at KeyBank, and there are plenty of places you can contribute to a health savings, an HSA savings account. Okay, I think we should move to the next slide. That's just little clip art. And I want you to think about these gardens that you're planting. And if you're not, start planting. Next slide. Well, I ended up talking a lot about the Roth IRAs, right? I wanted to make sure we covered it, but look at letter B. Yeah, so I think so many people just don't do it because they're not quite sure. And that's why I want to give people the confidence to participate. And just like you, just like, I'm reading the chat, but I'm going to keep talking here for a minute. Just like you wouldn't want to invest in just one mutual fund or one stock in your investments, you shouldn't have all your retirement money in one tax status. You don't want it all in pre-tax. You don't want it all in after-tax. You want to have some in never to be taxed. That's the Roth IRA. If you don't have any of that, it's good stuff. It should be part of your diversification of tax status in your retirement assets. Another thing is that when you take money out of a traditional IRA or 403B or any kind of retirement plan where it's taxable, it can affect the taxation of your Social Security. But taking money out of a Roth IRA will not impact your Social Security taxation. A lot of people don't think about that, but up to 85% of your Social Security can be subjected to income taxes. And also, I want to say that it is the very best asset to leave to your children or grandchildren. So if you are accumulating money in a variety of buckets, your 403B, your traditional IRA, a Roth IRA, plain old savings account, save the Roth IRA for the very last dollars to use and try to leave it to kids or grandkids, because that's a real good gift. Have a young person inherit a Roth IRA, especially if they're under age 18. They can take it out of their life expectancy. Once they hit age 18, they have to take it out over 10 years. But you'd want to wait till the 120th month, take out the money, give it the greatest chance for growing. For people who are thinking about converting traditional IRA money to a Roth, do it when the market dips. You also, I believe, if you have money in the pre-tax side of your Roth 403B, assuming UH allows for money in a Roth 403B, you can, or traditional and Roth side in the 403B, you can convert the traditional side, the pre-tax side of the Roth, of the 403B into a Roth 403B within your plan. So ask your retirement plan department or HR people about that. You can do conversions within the 403B plan if you've been doing the pre-tax contributions all along. Once again, that letter B, small letter C, find a dip in the market. Let's say we're going to have a market correction at some point. When the market corrects, consider converting money to a Roth, either traditional IRA to Roth or within your 403B, and convert to a Roth 403B within the 403B plan. So there's like corridors within your 403B plan, pre-tax money and Roth money. I'm almost certain that UH does it because most big institutions allow for that. So, and you can do a mixture. If you're putting, let's say you're putting 6% into your 403B plan, put 3% into the Roth side of the equation, 3% of the pre-tax side of the equation. I would vote all for the Roth side because I like certainty. I like to be insulated from taxes, but at least do some. Let's go to the next slide. Oh yeah, anybody have self-employment or spouse with self-employment? 20% of the income is tax-free as a qualified business income deduction. That's part of the Tax Cuts and Jobs Act. Self-employed people can have their own retirement plan. And also you might be eligible for Paycheck Protection Program, a forgivable loan. That's a very powerful tool. Next slide. Okay. Gallery view, I don't know. Oh, I see. So Angela, are you throwing me these questions? Because, okay. We have money interest is after tax due to income limitations. Can that money be moved to Roth without? Arthur asks, if you have money in a traditional IRA that is after tax due to income limitations on pre-tax, can that money be moved to a Roth without paying additional tax? Maybe. That's where the devil's in the details. So if you want to ask me directly, it's a little complicated. There's an exemption percentage formula that I can tell you about, tell you how it works. I'd have to kind of take inventory of all your assets. Angela, I don't know where we're at on time. I think we're close to the end, but I'm still willing to answer questions. Okay, what about if you do have yearly medical expenses because you have a condition? Do you still recommend not touching your HSA monies to pay your medical bills, but instead use, yeah, if you're able to, use your own money to pay for your out-of-pocket bills and let the money grow, because you get tax-free growth on it. And then you might have more medical in the future. Someone says, how can you help us privately for financial planning? Well, we're for hire. I'm not an investment advisor, but I know a lot about how taxes play into that process. And let's see. Angela got kicked out of the program. There's 3 minutes left. Okay, well, I'll just keep talking. Ask me questions. Just send me. Yeah. Okay, yeah, I got a couple minutes left. Angela's the host now. Okay.
Sorry about that. My computer shut down for some reason. So did you lose the presentation?
Oh, I guess I did. I didn't even think about it because I was just
Okay.
with people. Yeah, I think we're probably at the final slide where it says any questions.
Yeah, that's the final slide. I apologize.
No
Let's see.
problem.
And I will get the presentation out to everyone. Was there anything that I might have missed, or did you see the chat or anything?
Oh yeah, I saw the chat. Really, I may have missed a question or two, but I think I dealt with them as I went and read them and answered them. And I am more than happy to take a phone call or an email and help in any way that I can be helpful.
And your contact information is on here, Stephen?
It's on the slide. Yeah, it's on the
Okay.
PowerPoint.
Okay, great. Well, thank you everyone for coming to the PowerPoint brown bag today. And thank you, Stephen, for presenting for us. Wonderful topic for February.
Yeah, no, I really enjoy helping and welcome your questions afterwards if there's anything.
Okay, everyone's asking just how to get the copy of the presentation. I run a report to see who's in the Zoom meeting, and I can use your name. Sometimes email addresses show up and usernames show up, so that's how I get your contact information. But if you're concerned that you don't have the contact information correct for me, you can always email me at angela.padula@uhhospitals.org, and I'll get the email to you.
Okay, and I'll look for anybody's questions that come to me.
Yep, and they said that they might email you, so your email address, phone number is on there, so you guys can feel free to contact Steve.
Sure is. Sure
Thanks.
is.
Well, thank you so much, and you guys have a good rest of your day.
Okay, thanks for including me. Bye-bye.
Bye-bye.